Welcome to episode 1 of series 3 of our OR Talks podcast. Here are your hosts, Neil Seeger
and Marc.
Happy New Year. How are we on series 4? 3?
You've got a year ahead of yourself, don't you?
Absolutely, I have. How are we on series 3?
I don't know. We've survived 2 series. Apparently, we're surviving a 3rd as well.
Absolutely. Well, we've got spoiler alert. We've had the contract for series 4. No, but in all seriousness, though, that is it's a slip of the tongue. But actually, I think it's. I actually can't believe we've done that many.
Time flies when you're having fun, and hopefully everyone's learning and understanding a bit more about what we do and what we can offer and how we can help. So.
And actually, learning and growing as we all are, really. Every episode we learn something new. Well, I certainly do.
I know I do.
Probably learn it off you. But I think it's been great.
Yeah, it's been great. Has been really good and really informative. And I've enjoyed meeting other people from within the company as well and learning about what they do.
Learning about what they do and how they do it and all the key things that come with them. So hopefully today we got Henry with us. Hopefully he gives us a few key pointers of how to prepare.
Yeah, how to prepare. Yeah,
and forward planning. So thanks for joining us. Today we are joined by a very special guest, Henry, one of our tax advisors. Hi Henry.
Hello, you alright? Nice to be here.
Well, we'll see how you're feeling about half an hour's time. Once we've asked you really silly questions.
So I'm looking forward to this. I can grill him on personal tax and see what he knows.
Well,
at least you'll learn something. You'll learn something, I'll learn loads. So Henry, what we're looking at here is sort of things that are new. It's going to be what to look forward to for the new tax year. So the new tax year being 24-25. Which seems like miles away, doesn't it? Considering we're in January. Yeah, it's a couple of months, but it feels like you say 24, 25, you're thinking, that's years away, that. Yeah. It's not, it's actually on our doorstep.
Especially for us in tax, because we're working on 22-23 returns at the moment.
Yeah.
We're in the 23-24 tax year, and we're going into the 24-25. So you've got like 3 tax years going on in your head.
3 lots of legislation, you've got to remember. You can't even forget the old stuff, because it's still creeping up. So obviously looking at, obviously people listen to this, what would, if you were, with all the new rules coming out, in fact, what are the new rules coming out? Are there any headline ones to think about? Mark? What's changing?
So we've got the guest here, why am I getting the pressure?
Henry glanced at you and I thought, right then, I'll just throw a name out there.
I think the main one that came to mind for me was the dividend allowance. Obviously, spanning across the 3 tax years, so 22-23 it's currently 2,000.
Yeah.
For 23-24 it's coming down to 1,000, and then from the 6th of April 24 it's going down to 500. So that's something that's commonly used for planning to use that nil rate there. Unfortunately, that is reducing. So yeah, not great.
so then when we're planning, we'll look at effectively using your personal allowance, so your 12,570 plus £2,000 worth of dividends. Historically, in the current year, we're looking at going, well, actually, we can have effectively 13.5 grand with dividends and salary tax-free. Yeah. If you're a company director, obviously, shareholder, not just director, shareholder. Sorry, almost got me. And then next year, you'll be talking at just over 13,000 then, really, won't you?
Yeah.
Because the personal allowance isn't changing.
At the moment, it's forecast to stay the same, isn't it? So who knows? So with elections, you never know.
So we're all getting pay rises with inflation, and then the personal allowance is staying the same. So more of us are paying tax.
Yeah.
Yeah. But yeah, dividends have been hit really hard, haven't they? I remember when I started back in tax way back when, basically all basic rate was tax-free, wasn't it?
But that notional tax credit was back in the days.
See, I can't comment on this.
Oh, that's how old we are. That's how long we've been doing this now. So anything else that's obviously personal allowance we've said isn't changing. Dividend allowance is changing.
Yep, so on the capital gain side, you've currently got the annual exemption, that is at 12,300, and unfortunately that's reducing as well. So it's not good news today, actually.
I'm not going to ask this guy, he's like doom and gloom.
It's a massive change that though, isn't it? So like in 22-23 it was your 12,300, isn't it? And then in the current year it's gone down to 6,000. Then next year it's going down to what, Henry?
Is it 3,000?
3,000.
So that's if I'm making, if that's someone selling shares, if I'm doing property, any sort of investment activities that I'm selling, that sort of side of things, then obviously there's special rules. I know it can be very fine line between trade and investment, capital investment side. But if I sell my old painting.
Yeah.
Oh, okay, buy-to-let property. Someone's got big time. I'm cheap, my paintings. If I just sell me 40 grand painting as a one-off thing, actually back in the old days, I'd have had a smaller proportion I'm paying tax on. But now, if that is the example, I'll be paying tax on 37,000 of that.
Exactly. Yes, it's a big change.
Oh, that is a big change. That's a very big change.
Yeah.
Oh, well, any more doom and gloom or?
Pass the marks if there's anything more bad news.
They're the main sort of things, aren't they? Really. So,
yeah, they're the key sort of change in allowances, aren't they?
Yeah, there's been no change to things like the level where your income, if you're over 50,000, if the high income child benefit charge, that's still at 50,000.
Yeah.
Like that. So things like that haven't changed. Personal allowance over 100,000, that's still
as it was.
tapered away. Yeah.
Yeah.
The change isn't there with the pension contributions, which will probably.
I was going to come on to pension contributions, because there's two sides to pension contributions. There's the one that if I'm self-employed, and also there's the change if I'm a company director as well. There's or a director, shareholder, whichever way you look at it. Mainly director as an employee.
Yeah.
What are the changes in there then?
So everyone has an annual allowance that you can put into your pension, don't they? So previously it was 40,000, wasn't it, each year?
Yeah.
And then the changes to that, and we'll let you talk about those if you want.
I'm not sure I'm too fair, so
Oh, no, sorry.
Sorry, I was thinking it all.
Well, there's different sides. There's all different areas of tax, isn't there?
Yeah.
And this is an example actually that actually we specialise in different areas, don't we? You know, some of us specialise more in pensions, some of our corporate, some are personal. We all have different areas we specialise in. So
yeah. So anyway, currently then £40,000 for generally, unless you're a high earner, it gets tapered down. Then if your income's over sort of 250,000. But yeah, 40,000 generally for most people is what you put into your pension each year.
okay, yeah,
It's going up to 60,000.
yeah,
That includes your employer's contributions and your personal ones as well.
okay,
And if you put into your pension yourself, out of your income after it's been taxed, that gets grossed up as well. You get 20% put on top of that. So those are sort of thresholds to be aware of.
So if I'm a limited company director, employee, just a normal small limited company, and I want to contribute some money out of my limited company into my pension, okay, and obviously all the rules are ticked and all that sort of stuff. It's really simple and a really nice rosy world. I can put in 60 grand a year into my pension, and have no implication. I can save corporation tax on that. Okay. So what happens if I haven't contributed for 5 years? Can I use my stuff I haven't used before?
Providing you've been a member of that pension scheme or a pension scheme in the 3 years previous, you can carry forward any unused allowance from those 3 years.
Okay, so I've just stopped contributing for a bit, and I haven't contributed for 3 years. I can then use my unused entitlements, assuming those boxes are ticked.
Yeah, that's right, isn't it, Amy?
Yeah, essentially, yeah. So Mark's the good news on the bad news.
Yeah, I like how we're doing this. This is quite nice. This is quite. I didn't think we'd play each other off like this, but yeah. Is that what you're wearing a lighter shirt? So you don't seem quite. Mark's the good news, the dark shirt. We're playing games here. So if I'm a self-employed member, self-employed person doing a normal tax return and whatever, sole trader or a partnership. If I contribute to my pension, then does that make, and can I extend my tax-free allowances or anything like that, or lower tax rates or anything like that?
Yep. So essentially, if you make personal pension contributions, say sole trader, the relief there is essentially grossed up by 20%, and that extends your basic rate band depending on what band you're in, essentially.
So if I contribute to it, and let's just say my self-employment profit is 70,000.
Yeah.
Okay, and I've contributed conveniently 20,000 into my pension.
Yeah.
So therefore, I wouldn't pay anything at 40% then, would I?
Yeah, essentially, yeah.
Yeah. So extends it. So adds it on top of my basic rate band.
Yeah.
So handy then. So if I'm I'm actually could be saving myself, tax by contributing to my pension.
Exactly, yeah. So this is the perfect time, now in the end of the tax year, to be planning for that as well.
Yeah.
Because it has to be done in the tax year. You can't do it.
You can't accrue for it.
Yeah. It's got to be when it's paid. So now's the perfect time. So you're going to have a rough idea of what profit you're going to have or what your income level is going to be for this tax year, aren't you?
Yeah.
It's the time to look at those.
And what is that, Mark? You
Forward
strap line,
planning.
absolutely. Forward planning.
Yeah, forward planning. Preparation.
It's Mark's common line. He loves the forward plan. It's all forward planning, isn't it?
Well,
Everything.
it makes our jobs a lot easier, doesn't it? It's a lot easier to be like proactive than be retrospectively trying to see what we can do to fix things.
Absolutely. And this is why we're doing this now in January. So you've got a couple of months. If you need to contact financial advisors or those sort of things to have a chat about pensions, and that's a good time. We work in partnership quite, with them, don't we? So we'll talk about what the tax implications are of that, because obviously they can't comment on tax and we can't comment on which pension's the best way to do it. We can tell you what tax you're going to save, but the rest of it is, we're out of that.
Yeah, it's the perfect relationship really, because tax is just one factor of it, isn't it? There can be other reasons for doing it. The tax might not be the best reason to do it, but there might be another reason from a financial point of view for doing it, and vice versa. So working together is the best way, really.
You get the best result then, don't you? We all win then, don't we?
Yeah.
You don't end up paying 40% tax. You don't need to pay 40% tax.
Yeah.
And actually, that 20 grand contribution that we talk about, assuming it's all rice and rosy and it's bang on 70,000, actually, it's not going to cost you 20 grand to do that because you've got tax saving that comes with it.
Yeah, exactly. Yeah.
Ah, interesting.
I had some good news then. So.
Oh, you had some good news. I'm glad you sat down then. Go on.
No, I said that was good news.
Oh, that was good news. Oh, I thought you were going to come out with some good news
then.
So has anything else changed? Any of our rates changed, or anything else changed?
Top of my head.
There's a bit of the national insurance, isn't there, that we discussed on a previous podcast.
Yeah. What was that then?
So self-employed people, for instance, they're not having to pay their class 2 anymore.
And that's in effect of this tax year we're currently in, isn't it? That's exactly. The one, 23, 24.
Yeah,
okay, so this is stuff that's in for, as I said, the tax returns we'll be doing after the 5th of April. So what's happened there? Sorry, Mark.
So class 2 national insurance now doesn't have to be paid. So unless you can pay voluntary, if you're below, I think it's like 6,000, isn't it? The exact limit, but roughly 6,000.
Yeah.
Pay voluntary. Otherwise, you don't have to pay it anymore. You're deemed as having the credit already. So
okay, so you're deemed of paying it without already paying it. So that was the old. So I think it was like 168 quid, whatever it was. That's the one that was the one you'd have paid. It's not based on profit level. Well, it was based on profit, but it's not a percentage of profit. It's a flat set amount. Yeah. So that one is now.
Yeah, it's been talked about for years, getting rid of it, and they've actually finally done it now.
So they've dropped. So obviously they've done that with class 2. Okay, so have they done it in class 4? Have they done anything nice? Have you got any good news for us?
Yeah, absolutely. So the class 4 has also come down from 9 down to 8%, and that's from I think the 6th of January.
So 6th of January.
It's already happened now.
So it's already in. It's already in.
It's in.
But it'll be effectively, I mean, just using simple full months, obviously, it's going to be effectively you'll end up apportioning that, I assume. So you'll have some at 9% and some at 8%.
Yeah, so it'll be a hybrid rate basically for the year, won't it? So.
Yeah, which is still a saving.
Yeah, it's good news.
That is still. So obviously we spoke about self-employed people, and we spoke about. So what happens if I'm a limited company director and I'm just on salary? I'll just have a nice salary, no dividends. That's all I have. Let's just make up a number: £36,000 salary. Have I got any savings that are already in, or that I can look forward to in the future?
So primary class 1 national insurance was at 12%. In the autumn statement, it was cut down to 10%, and I think that's one that's also came in the 6th of January. So once again, so that's one that will also affect this tax year as well.
So I'm saying, blimey, you've become good news. See, so already in these things are. So that's another good saving. So actually, even as an employee, I'm actually going to be saving money. It's not just self-employed people that are saving money. I'm going to be saving too.
Everyone will see a little increase in their January pay packets.
I've got a pay rise. That might cover up for the fact my pay's gone up and my personal allowance hasn't gone up.
Someone's boasting about pay rise, isn't it?
I was letting count the bag there. Sorry. No, but I think that there are many positives. I mean, I know they've cut a few allowances, but I think with how good they were, during COVID and all that sort of stuff, they're going to try and get some of that back. Obviously, with not a political podcast, obviously it's more, but actually, there is going to be somewhere of But we'll see. That might change with.
I was going to say, there's going to be an election at some point this year, by all accounts, isn't there? So everything could literally change on that.
We could be rewinding this, getting rid of the good news.
But that doesn't mean you shouldn't do planning now.
No, absolutely.
You should act on what we know now, and then what happens in the future.
Well, here and now it's right, isn't it? So for the tax year we're talking about, with making provisions for your pensions and being proactive with that. That's a good. And obviously, then it comes down to equipment as well. Obviously Everyone talks about, we hear it all in the pub all the time, spend as much money as you possibly can on equipment because you're going to save loads of tax. But actually, we all know that you only save the percentage of the tax. You're still, let's just say tax rate's 20%, you're still 80% worse off cash-wise, so don't buy it unless you need it.
I was going to say, you've still got the cash there to buy it, haven't you?
Oh, absolutely, but if people are looking to buy, obviously there's allowances there to use.
Yeah, so definitely it's worth looking at.
But talk to us before it comes to the end of the tax year. Don't just, say, I wish I could have done that, because we actually can't do anything about that either. It has to be, bought really. You have to have an invoice for it before that point, before the end of the tax year.
Don't just provide a random number on a piece of paper. I'm a 30th of Jan after.
No one does that. Nobody. So what? Is there anything else that's changing that we've got to be aware of?
So just back onto the pensions. Previously, there was a lifetime allowance of what you could contribute into your pension before your tax charges started coming in.
Okay.
That's actually been scrapped now, isn't it? So going forwards, if you were previously at, it was about just over £1 million the limit was.
Yeah.
If you were at that, you can actually now start paying into your pension again.
So even if let's just say I was at the point where I put in like 999 or whatever it is, let's just say around, I know it's not, but let's just go easy numbers.
Yeah.
Around £1 million was the lifetime allowance. Yeah. So I've already put in, say, 999.
Yeah.
Put all of that in there, and I was already at that, so I couldn't put any more in there. I can now contribute again.
Yeah, because they've abolished the lifetime allowance charge. You can now carry on contributing.
And is there an effective date for that?
Yeah, so how it worked with the legislation was a bit complicated, but effectively it's gone now for this current tax year.
So as at today, I could contribute into mine.
Yeah.
Oh.
But obviously, always speak to a financial advisor.
Obviously, we're only talking tax. We can't tell you whether that's a good life decision or not. Yeah. We can say it's good for tax, but not necessarily good for.
Good if you can retire.
No, absolutely. I mean, it'd be nice to have the £1 million there to put into, wouldn't it? To be fair, but those sort of things are there, and that's a massive change actually.
It is, yeah. So there's a lot of people that had contributed up to it, stopped paying, stopped thinking about pensions, that can now utilise them again.
Because as you said, the legislation was quite, I tried to read it and it got well complicated. So I thought, do you know what, I can look at Mark up and just go, Mark, what do you think? Or a Henry, obviously. Yeah. Obviously, let's not miss you out. Absolutely, yeah. There's not many Marks. So, anything else that we can plan with?
There's usually some things like gift aid as well, isn't there? So I'll let you explain how that sort of works.
Yeah, so essentially kind of in the same way as the pension. So say, for example, you get 20% tax relief on gift aid. So if you make a £10 donation, make it a small amount, you'd get your 20%, make it £12. That would then increase your basic rate band. Obviously, that's a very small amount, so not much difference, but we do have a lot of clients, particularly kind of at an older age, who do use that gift aid and do therefore extend their basic rate band and do make use of that.
So gift aid is if I give to registered charities, I assume. It's only registered, I can't just give it to, Jeff who's about to run a marathon.
Yeah.
It doesn't quite work like that, does it? It actually goes through proper gift aid, registered charities.
UK registered charities.
Yeah. Okay, that's also very good actually, because I suppose that goes hand in hand with the planning to get the end of the year. So obviously, and it also goes in with a bit of inheritance tax planning side of things, really, doesn't it? So you can have it out, donate it, so you don't have the inheritance tax potential problems. I'm talking not £10, obviously, but different levels. but it works into a few different avenues of tax planning.
Yeah, with your inheritance tax as well. Obviously, coming towards the end of the tax year, you've got X amount you can give each year, haven't you?
Yeah.
It's about £3,000. So if you haven't utilised that and you want to, don't forget to do that as well. So
I think as well you can use your prior year 3,000 as well if you haven't used that. So if you haven't used your prior year, it's up to 6,000 in 1 year that you could give this year.
So there's different thresholds for all sorts of things, isn't there? There's a very long list of things you can give and certain allowances for each tax year, but it's worth utilising those, isn't it? Yeah. As you said, because then it helps you plan for inheritance tax planning, and also helps you, helps everyone else out as well. To be fair, if you're giving, it's not always necessarily the current or last tax year benefit. It actually will benefit your family as well.
Yeah, and I'm sure we'll do another podcast on inheritance tax planning because it's a massive subject.
We can talk about that for the rest of the day, to be honest.
And it's something people always put off, don't they? They never want to look at it, never want to think about it, but the earlier you do it, the better, and you can keep updating it and evolving it. So do it once doesn't mean that's it set in stone.
No, it'll change. It can change all the time, can't it? It's always changing, potentially. So if we're talking about planning, so if we're talking about the things to utilise for at least the next probably 4 or 5 months, it would be looking at your pensions,
Yeah.
if you've got the cash to do so, looking at buying equipment if and so you need to. Okay, obviously I think they changed. It's a really big topic, but they changed research and development things, didn't they?
Yeah.
So that's maybe not quite so attractive as it used to be. But that's another thing to worth looking at, because that's on a tax year basis as well, isn't it? Research and development. So if you are doing it and you want to look into claims, then obviously that's something that we can do.
Yeah, that's more for the limited companies, though, again, isn't it?
Sorry, good point. Doesn't work for people that are doing tax
just
returns.
to avoid any confusion with any sole traders.
See, you can tell he's a tax guy, can't you? He's too switched on for me. So yeah, the pensions is his thing. Equipment maybe, but actually your main benefits is you're saving your national insurance.
Yeah.
And going forward, if you are looking to make capital disposals, then it might be worth looking at potentially doing them. If you are thinking about looking to sell, maybe do it in this tax year rather than next tax year, because you've got more tax-free allowance.
Yeah.
And you can't, and that one you can't use unused entitlements at the end of the tax year. It's gone, isn't it?
That's it. And it's probably worth reminding people of the bands as well, isn't it? To be fair, what rates, what levels you go into the different rates and everything. You want to run through those, Henry?
Yep. So essentially, your 0 to 12,570, as long as you're under £100,000, is tax free. Then your first 37,700 there is at 20%, and the remaining up to 150,000 is at 40%, and above that you're at 45%. Please don't ask me the Scottish rates.
No, we don't talk about that. We don't talk about that.
That's the rest of the UK.
That's a separate podcast. That is. Yeah. So wait, let's just break that down a little bit, because my brain couldn't keep up with you there.
Sorry.
A little bit fast for me there. So, no, I'm old. That's my problem, and I have to understand it. So, what was my rates again? So my band for my 10%. So it says it's 10 and 20.
No, so sorry, it was at 0. So your first 12,570 of income is essentially tax free.
Okay.
Or to phrase it a different way, if you have your basic rate band at 50,270, you deduct off your personal allowance.
Okay.
That would then leave you with 37,700 taxable at 20%.
Yeah.
And then from 50,270, if you like, then through to 150,000. That's at 40%.
Yeah. Okay.
And then above 150,000, you'd have your 45%.
And that's just my that's my that's my self-employment. So that's my normal income tax thresholds.
Yeah.
Are there different thresholds for capital gains tax?
Yeah. So for capital gains tax, it essentially follows the basic rate band the same, and then above that, it's the higher rate. There isn't like an additional rate.
Okay.
Also worth noting for capital gains tax, you've got for non-residential property, the basic rate is 10% and the higher rate is 20%.
Okay.
For residential property, it's 18% and 28% respectively.
Okay.
I believe that's staying the same. So
I'm not aware those are changing.
So,
Yeah,
Some different rates.
Yeah, a couple of interesting points on the residential property as well, because at this time of year, we're completing people's self-assessment returns.
Yeah.
There's a lot of people that have sold residential property and have capital gains to pay. You have to report that within 60 days of completion.
Okay.
And a lot of people still aren't aware of that and are missing those. So when we come to do the return, that's the first they're telling us that they've sold something, and then it's late, that capital gains return, and there'll be penalties and late interest on the tax.
I was about to ask what I was about to tell you, but
Yeah.
you've already answered my question.
Yeah. So if you sell a residential property, tell us straight away, or as soon as you put it on the market, really, open that dialogue with us and we can talk you through the tax.
And make sure they give you the key dates.
Yeah.
Because
exactly.
you say once you've missed them, you've missed them.
Yeah. It's a short window, and it's
Easily done, isn't it?
Yeah.
Once you've sold it, you're in the wave of I've sold a property, I need to find the new one, or what do I do with the money? You don't necessarily think about the tax.
Yeah, that's it. It's one of those. It's not widely known. Like, we put a lot of information out there on it, but it's easy to get overlooked. So
it's an interesting question.
Oh.
And I'm asking this one because
I get nervous.
No. It'll be absolutely fine. But it's one thing that I got asked this the other day. If I've sold my residential property and I do my capital gains tax thing within 60 days, I'm good as gold.
Yeah.
I pay my tax.
Yeah.
Do I have to do a tax return still?
Are you in self-assessment already?
Yes.
Then yes, you still need to do your self-assessment to report whatever else. If you're not in self-assessment, then no.
Okay. So you say, okay, that's an interesting. I didn't realise that.
Yeah.
I would have thought you still would have had to.
Previously you did. Because this is such a new thing, this 60-day reporting, it is evolving all the time. So originally you still had to do your self-assessment return. They've changed it now, so you don't.
Ah, okay. The only reason I'm asking that because I would have thought because other income, so my other income uses up my band. So let's just say I've got a £50,000 salary and I sell a painting again for 40 grand. Okay.
Yeah.
Well, let's just go easy. 43,000. I take off my £3 grand allowance. I'm doing it next tax year because everything, all my capital gains is going to be at the higher rate, isn't it? At the 20%. I don't pay anything at 10.
Yeah. It's still dealt with within the POE system, I believe. I'll have to double check on that.
Yeah. That's just an interesting point because somebody asked me that the other day and said, well, I ceased my self-employment last year, but I'm still registered to do a tax return. So therefore, you still have to do a tax return. Was my advice, but that's people don't realise that.
Yeah, it is an evolving system, isn't it?
Yeah.
So,
well, when it comes up, we get an update. We'll obviously update you guys about that as well.
Yeah. The other thing to mention as well is on that 150,000 for the 45% rate. That's actually been cut, isn't it, from April this year, I believe. It's come down to the 125,000.
Okay, so I then pay more at 45%.
Yeah, and that's at the point where you've completely lost your personal allowance as well. Yeah, so that's quite a big change, to be fair.
It's the positive to start with.
Yeah.
So actually,
I don't make the rules.
we just report them.
Yeah.
We just explain what they are.
Yeah.
If only we made the rules, that'd be good, wouldn't it?
I don't know.
So actually, if I do actually, earn 150,000, then actually I'm going to anything 100 and up to 125,000, I lose my full personal allowance.
Yeah.
So therefore, not only am I paying tax on everything I earned, I would pay more at 45%.
Yeah, going forward, after this tax year.
So that's for 24, 25.
Yeah.
How interesting. Well, I mean, but then again, I suppose you're only 150 grand, so
It's all relative, though, isn't it?
Yeah.
Everyone lives to their means almost, don't they?
Yeah, absolutely.
The way society is these days.
But it's good to plan, though, isn't it? Because if I'm talking about do I take a salary or take it as a dividend, or do I take it as a pension contribution, then obviously these rules, or particularly if I'm done my lifetime allowance or what was the lifetime allowance, so I've had to then take it as salary or not take it at all. Well, I'd rather take it and contribute it to my pension than pay 45% tax on it, wouldn't I? Assuming I don't get the cash, obviously.
Yeah, you've got the flexibility in how you take your remuneration, and
But it's handy to know that, isn't it?
Yeah.
Very handy for forward planning. Anything else? There's nothing else I've got at all that's changed, or that I'd use the forward plan. Yeah, I think the other thing is obviously with people getting to this point and talking about limited companies and whether to move from a sole trade to a limited company or from a limited company to a sole trade and when's the right time to do that. Well, actually, before we get into the worst time to do it is when you're midway through a tax year. If we are planning to make a change, then you'd change it potentially for 24, 25.
Yeah, and there's a variety of things. It's not just tax that should drive that, is there?
No, correct.
Commercial, like for your business as well.
Yeah.
Protection and all sorts. So tax is one factor, but there are a variety.
Oh, there's a multitude of others. Yeah. It's just another thing for planning, isn't it? To think about your pensions, think about your national insurance saving, which is nice. To think about all those sort of things. But that's the idea of this, is we can actually explore the avenues that people, just to give people pointers really.
Yeah.
It's not the answer, this is just a flavour pot really. It's not the final packet of crisps. We're just putting flavours in there to see what it tastes like. I haven't got anything else at all for today.
Can't think of anything else.
No, so well, Happy New Year. I suppose it's a bit late really. Happy New Year. Now we're at the end of the month, but yeah. Good.
So, thanks, Tony. That was really
thank
helpful.
you.
Thank you for having me.
No, thank you for coming on. It's very useful.
Okay, so thanks for joining us today. Hopefully you found it interesting and you've got some ideas about planning that you can do coming up to the end of the tax year. If you've got any queries at all, get in touch with whoever it is you deal with it or Moderator, and we'll be happy to help. And next time we're going to be talking about our apprenticeship schemes.
Yeah.
So hopefully we'll have a few people on to talk those through with us.
And give us tell us what they do. What is an apprentice like? What does an apprentice do?
And what you can get involved in if you're interested in joining us. And what the process is and what to expect really.
Quite looking forward to that.
So yeah, me too. If you've got any queries or anything you want us to cover on a podcast, drop us a WhatsApp on
01905 777 600.
Seamless now. See, that's
absolutely.
Series 3 and we're on it.
It's only taken us 2 series to get to this point.
Yeah. So thank you very much for joining us, everyone. It's been a pleasure.
Thanks for joining us. See you next time.